Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining us today. I say us because I have a friend in the house today joining me on the podcast. I have Brittany Green joining me as a guest and a co-host today. Brittany, welcome.
Hi.
Glad to have you. You've been on the show before, so I'm glad you're back.
Yes, thank you for having me.
Yeah, we are going to talk home buying stuff, which is of interest to a lot of people today. So I'm going to do a quick intro, and I'm sure you want to add some stuff about you as well, but I will go ahead and kind of introduce you, Brittany. You are a senior loan officer at Tucker Mortgage. You are a native Indiana native, I should say. And you've got an interesting background. You moved to Indianapolis in 2011 after earning a criminal justice degree.
Yep.
And you had a career in loss prevention for a while, became a mother in 2016, and changed your career path at that point to work part-time as a front desk coordinator for FC Tucker. And then after a year, you were promoted to a full-time position of prospecting and first impressions coordinator, and then quickly transitioned to be senior loan officer at Tucker, where that's your position today. And you help a lot of people navigate getting a mortgage, the home buying process, educating them in a lot of ways beyond just the mortgage process as well, which I really appreciate about you. And you're mother to two young, amazing boys. I have a 6-year-old boy myself, so I know how fun that is. And it looks like you also have an inclination for creating your own dance party. So that's what one of your claims to fame, right? Family dance parties.
Oh, yes. Yes, we do enjoy those.
Yeah. And you're very into fitness. You have kind of a side gig. I shouldn't say a side gig, but side interest, maybe kind of a gig in fitness. And I think you run some fitness events in your office too, right?
I do. Most recently, the Ultimate Plank and Hold Challenge.
Nice. Tell me more about that. You're the reigning champion, right?
I mean, I didn't compete, but the competition was to try to beat me. There was still first, second, and third place. The top winner was, his name is Garth. He's out of the Tucker Keystone office, and he held his plank for 11 minutes and 11 seconds.
Wow. I can do maybe 30 seconds.
Huh?
I can do maybe 30 seconds.
Yeah. Unfortunately, or fortunately, depends on how you look at it, I'm very competitive, so I had to stay up until he fell. So I did get the 11 minutes and 12 seconds.
Right on. So the unofficial reigning champion there.
Yes.
All right. Well, obviously I made an effort to do an introduction of you, but what have I left out? What else would you like to share with our audience about yourself before we jump in?
Oh, no, my boys are just my world. So you hit it on the head there with my 5-year-old Madsen and my 3-year-old Emmett. They are amazing and incredible little boys. And then I do have an amazing boyfriend, Matt Allen, who is the owner of Iconic Insurance, so individual health insurance and small businesses. So if anyone's looking for that, I can help them with that too.
That was on this show a few episodes ago. So
oh, yeah.
Yeah, he's a repeat visitor as well, just like you. So all right. Well, let's talk home buying today. That's the topic. And I think this is great because obviously the housing market is kind of insane right now. People are buying and selling and trying to buy and failing and just navigating the housing market is crazy right now. And I think often when I say we, I mean just people in general, all of us sometimes, it's very tempting to get super excited about buying a home. It's like, okay, great. We feel like we're outgrowing our current home or we want to make a change. And the first thing a lot of people do is they just pull up, listings online and start looking and start dreaming. And that's a really easy way to fall in love with a house you're not ready for yet. And so I love the fact that you do a lot of work in educating clients on how to get ready to be a solid home buyer, because it's really important to have the right steps in place before going through all the effort and falling in love with the home and thinking you're at that point when you're not quite at that point yet. So if we could, I'd really love to walk through some of the points that you shared with me here that we're going to go through on how to become a solid home buyer. So I know we're talking things like credit, funding, general cost, income, all that stuff. So where would you like to start? What's the first thing you would look at or talk to someone about when they're thinking of buying a home?
Yeah, no, when buyers do contact a lender, they think they're in great shape to purchase a home, but it turns out their credit score might be lower than what the lender requires in order to qualify for a loan product. So what that means is there's different loan programs available out there, but all of them have a minimum credit score. So typically a lender is going to pull credit from all three credit line bureaus and take the middle score. So for example, if a buyer has a 600, 610, and a 620 credit score, the lender's going to take the 610 for all qualifying purposes. And if the loan product that they're trying to qualify for, if the minimum credit score is above that, they automatically don't qualify just by credit score alone.
So just to be clear, they don't average it, they just take the middle. So if you had like 610, 620, 680, they're taking 620.
Correct.
Okay,
Correct.
good to know.
Yep. So it's really important that even though buyers are using different apps, such as, I don't really want to say the ones that don't work very well, just because they do give the buyers a good idea of what their credit score is. It is a different scoring model. So when a lender does a hard pull and they pull from all three credit bureaus, it's not going to be the exact same as what the buyer was seeing on their app, unfortunately. And it could be very different, for the better or for the worse. So there are different things that a buyer can do to get a better idea of what their credit score is. A consumer has the right to know what's on their credit report, and so they are able to go to annualcreditreport.com. Again, that's annualcreditreport.com, and access their free credit report. So it's correct. That's going to give you a way better idea of where your credit score is, as opposed to the apps that are out there.
Yeah, and that's something I do with my clients every year, is encourage them to download their credit reports, all three of them. And it can be a pain to grab all three. I realize that, but it's really important, I think, to look through and make sure there's no errors, make sure you understand what accounts are open, make sure that, the account status is accurate. There's no, indications of fraud or errors in there. So I think it's really important to look at that, even if you're not buying a home, but especially when you're looking at home.
Yeah, so it's good. I would recommend that a buyer do that 3 to 6 months at least before they even want to purchase. Because if there are errors on there, or if there's anything else that needs to be taken care of, that gives the buyer enough time to resolve it. So a lender is looking for different things on a credit report. So it's not just score. What else is on the credit report? Because certain things cannot be present in order for a buyer to close on a home. So if there's anything in dispute, the lender may not allow that buyer to close until those disputes are resolved.
So dispute meaning even if you're disputing something that's inaccurate, just any kind of dispute that's open will cause that issue.
Correct. Yep. So it's highly recommended that you resolve those disputes as quickly as possible, or before you try to get a pre-approval done by a lender.
Okay.
So, and if there are anything, if a buyer does have below, say, a 600 credit score, for the different loan products out there. So one's the Tucker Mortgage. So I am the senior loan officer out of the Tucker Keystone office, but I do help buyers throughout the entire state of Indiana, regardless of which agency they're using. So whatever realtor they're using. But I'm looking at what their middle score might be, and let's try to raise it. So if they are able to go to annualcreditreport.com and see what's on there, then any lender can provide free advice. There's different things to help prepare a score or to increase it, even in like as little as 15, 30 days. But then there's some more advanced things that might need to be done that take 3 to 6 months. So that's why I say 3 to 6 months beforehand. Some of those things, pay your bills on time. Everybody knows that you're supposed to do that, but do it, because having any late payments on there can negatively impact your credit score. Different things like making sure that your balance for your credit lines is below 30%. So 10% is ideal, huh?
Your open balance.
Yes.
Yeah, okay.
So on the credit card accounts, making sure that balance is 30% or lower than the credit line limit. You can request an increase in your credit line if you're close to that amount, but they may require pulling your credit in order to do so. So it's kind of see what kind of requirements they have.
And that's a hard pull, so that could actually damage your credit score.
Yes, some places will do it without. So if you've been somewhere long enough and you have that payment history, they may not require it. They may issue it for you. So just kind of keeping those things in mind. And then if there is anything on your credit report that needs taken care of, or you're below that 600 credit report or credit score, then you might want to check out credit repair companies that can help you with increasing your credit score within that time frame. Things that they can see that I don't.
Okay, gotcha. One thing you've mentioned before, which I found interesting, that is that if a debt is very old, but then you suddenly start paying on it, it becomes a new debt and therefore becomes considered or ends up being considered in your credit report and can negatively impact you, right?
Yes, so it's really important for the buyer to contact a lender as soon as possible because they may think they're improving their score, but as what you're talking about is if there's an old collection on a credit report and the buyer's aware of it, they're like, I'll just start paying on it. It might not be a collection that the lender counts against them. So for example, medical collections, that does not impact the buyer's debt to income ratio. And if it's an old collection, I'm not telling them not to pay on an old collection. Just maybe wait until after they close before they do that. Because if they pay on an old collection, it becomes new credit history, again, negatively impacting their credit score.
Okay. So what about funds for down payment? We've talked about credit quite a bit. The next thing obviously is having the money, right? Having the cash to actually buy the house, right? What are some things you look for there?
So again, you're right. So we've worked on credit. Credit score is on its way. The other thing that you're talking about is funds. So different credit or different loan products require a different minimum down payment. So for FHA, for example, is 3.5% of the purchase price. So whatever you end up purchasing the home for, 3.5% down is what's required for FHA. So if you look at a $100,000 home, you need to bring $3,500 to the closing table minimum. That's the down payment. But what people don't realize is there's additional costs involved. We are in a seller's market. There's very little inventory. Buyers are having to get competitive on their offers that they're writing. So they're not asking that the seller contribute any funds towards closing costs or prepaids. And that's a word that people don't really typically know. That's taxes and insurance on the property. So not only are buyers needing to bring the down payment, so that $3,500 on a $100,000 home, but they need to estimate some funds for closing costs and the prepaids. I typically say you want to have an additional $5,000 for that. So really, you're needing to bring to closing $8,500 instead of what used to be just the down payment, because you would ask that the seller help with closing costs and prepaids.
Okay. So I think the FHA loan type is really interesting because a lot of people think, oh, I just have to put 20% down and that's all I can do. And the FHA product makes it really accessible for many people, especially first-time home buyers, which is kind of what it's designed for, to buy a house without this massive down payment. So are there any downsides to FHA?
So FHA is a good, strong loan product. Like you said, it allows for a borrower to put 3.5% down. There are things that buyers don't typically know about. So when they are getting loans, such as FHA, there's a thing called PMI, or private mortgage insurance. A lot of people say, oh yeah, but you have to pay PMI. That's not a bad thing. It is the ability to put less than what you said, 20% down, which is a significant amount of money. But it's insurance on the loan for the lender. So with FHA, there's also upfront mortgage insurance premium, or an upfront MIP. It's 1.75% of the loan amount financed into the loan. Essentially, you're not getting full credit for your down payment. Because when you look at, when people say, well, what's your equity? Equity is money. It's if you take a $100,000 home, you put $3,500 down, you have $3,500 in equity already. Okay, so the amount that gets financed, though, ends up being higher than, you're not just taking $3,500 off of $100,000. That 1.75% of the loan amount is financed into it.
Yeah, so the FHA is a more expensive loan, but the upside is you're able to get into a house sooner with less cash up front, which has a lot of value. The value of, time value of money there is in your favor sooner rather than later. So it is a trade-off, but like you said, it's not necessarily a bad thing. It's just the trade-off you're making.
Right. And with FHA, it does have a lower debt to income ratio. So if someone happens to have a little bit less income and higher debt, they still can potentially qualify.
Okay.
So it's good in that respect. There are just stricter guidelines when it comes to appraisals. So it's just knowing that that appraisal that occurs, a seller might not want to select that loan product because it sticks with the home for 180 days. So if another FHA buyer comes in, they have to use that same appraisal. So there are pros and cons. There are other loan products out there though. That's just FHA. If you go to conventional or insured conventional, and basically the difference for that is if you put less than 20% down, it becomes insured conventional because you have that mortgage insurance. FHA, that PMI, that private mortgage insurance, stays for the life of the loan unless you put 10% down. Then it's 11 years. If you go to insured conventional, it's a stronger loan product. Sellers like to see conventional or insured conventional come across their table when it comes to offers because the appraisals are a little bit, they're less strict. So they do appreciate that. And every new conventional buyer, the appraisal goes with that same buyer.
So I think some people don't realize that you can put less than 20% down on a conventional loan.
You can't. That's where it becomes the insured conventional. So you can put 3% down for first time home buyer. It's harder to qualify. You have to have a higher credit score, lower debt to income ratio, and 6 months of reserves. So there's kind of a range, 2 out of the 3 you need to have. But you can then, when it comes to buyers, they think of a dollar amount that they have to put down, when it might actually be more beneficial for them to do things at percentages. So putting 3% down and then going up to 5% is the next minimum requirement for insured conventional. But there's no benefit to somebody, no benefit. There's less benefits to putting, say, 7% down versus 5% down. So when they're putting that additional 2%, there's not much of a benefit. For every $1,000 you put down, you're only saving about $4 a month.
Yeah, it's getting a little more equity, but not a huge amount. Yeah.
No. So you might as well put the 5% down, keep some of your money in your pocket. The different increments, so it'd be 5, then 10, then 15% down. And then you get out of private mortgage insurance at 20% down. But for insured conventional, that mortgage insurance that is still required, it's based off a credit score and it's based off a down payment. For FHA, for those who have lower credit scores, it's not based off that. It's simply based off a down payment, that mortgage insurance. Insured conventional, it's based off the down payment and credit score.
Gotcha. And a lot of what you do, I think, is people come to probably not knowing which product is best for them, and you help them figure it out, right?
Yes. Yep. So based off the conversation we have over the phone, we talk about credit score, funds. We can kind of, when we have certain pieces of the puzzle, we can make it work to figure out, well, now how much do they qualify for?
Yeah.
It's not necessarily how much they qualify for. It's also what they feel comfortable spending based off of their funds, credit score.
Right. All right, let's talk about income. This is a sticky area for some people, especially self-employed people, because there are some pretty strict requirements when it comes to compensation history and where your income comes from and how long it's been consistent. So what are some of the guidelines when it comes to getting your income status ready to buy a home?
So for lenders, we do require 2 years of employment history. So what does that look like? And when it comes to getting pre-approved and then closing, details matter. That is probably the most important thing that we can talk about when it comes to a buyer getting prepared to be a solid pre-approved buyer is the details. So when we talk about 2 years of employment history, was there a gap of employment during the last 2 years? You do need to know the month in which you started a job and the year. It doesn't have to come down to the exact day, although the more details, the better, because it gives underwriters a really good, clear idea as to what you were doing over the last 2 years. So knowing as much information as you can, having the proper documentation. So when it comes to the income, based off of how you receive income is what documents are going to be required. So Michael, are you considered a 1099 or a W-2 employee?
Well, I'm self-employed. I own an LLC and am paid through my LLC. So neither. but I take distribution income. Yeah.
Okay, so that gives a lender a really good idea as to what documents are going to be required. So if somebody is considered self-employed or 1099, or if they're a W-2 employee, that tells them exactly what kind of documents are going to be needed. If you do receive a distribution, having your bank accounts, the last 2 months of bank statements to help prove what was being entered into your bank account through your distribution. If you have any letters, so if you have retirement, pension, Social Security, disabilities, whatever that you might have, there's usually an awards letter that's given to you at the end of the year to show what you're going to be getting the next year. Having certain documentation saved, because that's what a lender's going to need. And lenders use gross monthly income. So before all the taxes are taken out, not the net, but the gross, which can be a huge difference. So if a buyer doesn't have that information, and all we have is net income, you might have the ability to purchase more house if you wanted to, if you felt comfortable, if you qualified. So having that gross amount is really important. But for W-2 employees, so if you are thinking of changing up your job, consistency is great. When a lender is lending you a lot of money, they want to see that there's stability, the ability to repay. So your credit score shows that you have the ability to repay things on time. Your funds show that you have some skin in the game, and the more you're able to put down, the more benefits there are, because you're not just relying heavily on the lender. But the other thing is going to be employment. So if you have stable income, then the lender has, there's less risk for them to provide that substantial amount of money. They see that you're making that consistent income.
So to be clear, let's say you're a couple scenarios I want to run by you. Let's say you're a W-2 employee and you work for a year and then you switch jobs, work for a year, and then apply for a mortgage. Is it the 2 years of total employment history that's important, or employment at the same employer that's important?
It really does depend. My question is, was your first job a W-2 position, and was your second job a W-2 position?
Yeah, let's say they're both W-2 positions.
So that's strong. So it's good because you're going to have a W-2 that you get at the beginning of the new year for the previous year that's going to show the income that you had.
Okay.
Gross
It's okay to change jobs
and net.
as long as there's consistency.
Consistency. So they're going to look at your past 2 years of W-2s and see, is there an increase in pay or is there a decrease in pay? And then your year to date. So not only do you have your W-2s, but we need your most recent 2 pay stubs, or enough to cover 30 days. Or if you're paid monthly, we need the last 2 months of pay stubs to show that what you said you make, you do truly make. So there's a difference between a pre-approval and a pre-qualification. The conversation we have 3 to 6 months in advance is going to be more about a pre-qualification. We're going to talk about the different qualifying factors: credit, funds, income. When it comes to being that solid buyer to get pre-approved, then that's when you start providing the documentation that the lender is going to review and verify.
Gotcha. Okay, let's talk self-employed now. A lot of people I work with are self-employed. They either are a business owner or they're a solo business owner, maybe have a couple team members, but a lot of them are solo. And their income is all from distributions. They have a business account over here and they make money and they move money from their business account to their personal account, and that's their paycheck, so to speak. So I think a lot of people don't understand how to report that or to make sure that's appropriate type of income for getting a mortgage. But really, it sounds like you need 2 years of some kind of income. So it sounds like it does work for someone who's self-employed to have 2 years of saying, hey, here's my bank statement showing that the money went from here to here and it went into my personal bank account. And as long as they have those records, that counts as 2 years of income, correct?
Yes. So the lender's going to require 2 years of tax returns. So if you file your business and your personal together, that's fine. Or if you file them separately, then we require both the business and the personal tax returns. Then if you're a couple months into the new year, you also need a profit and loss statement that is very detailed. So you don't want to be general. Again, details matter. The underwriter is going to want to know where your expenses are going and where that income is coming. And then, are you at a profit for the year or are you at a loss? So they do take the last 2 years of your income on the tax returns and they average it. Or If your last year was less than 2 years ago, they're going to take the lesser of the two.
Okay,
They
gotcha.
want
So,
to be conservative.
right. So it's a really good argument for having really great accounting records and or working with an accountant to make sure your books are in
Yes.
order. That P&L statement comes in handy in many cases, not just reporting on how your business is doing, but getting a mortgage. So it's good news, though, for people that are self-employed. They have the option to buy a home as well. They just have to make sure the reporting is done correctly. So.
Yes, very true.
Now, what if you, sorry, one more scenario to throw at you because it's
Okay.
happening. Let's say you are running a business and you shut down that business and start a new business within the span of 2 years. This could be problematic. Yes.
It could potentially. So underwriters make the final decision. And one of the huge benefits of Tucker Mortgage is we're local. So I have my own processors and I have my own underwriters. I also have direct access to the presidents of Tucker Mortgage, David McCoy, who's president of production, and Michael Hall, president of operations. So I have the ability to, before someone even makes a jump and does that, let's run the entire scenario through actual underwriters and the presidents of the company. And then they can provide information saying, all right, as long as you follow this, this, and this, so specific guidelines, then you'll still meet those requirements. Because it's going to be, you have to follow the government guidelines and Fannie Mae based off of which loan product you end up with. So those are the requirements that underwriting is following, those guidelines.
All right. So if anyone's watching or listening in the Indy area, that's a great argument for working with you. And obviously people listen from all over the country here. So if you're somewhere else, then it's a great argument for working with someone local to you. It sounds like someone who kind of knows the community, can work with you individually. So it's a good argument for working with someone in your area.
Sounds yes, like. It's very, and generally speaking, it can change things because the lender wants to see that consistency. They want to see if you're in a specific field, how much are you making over the last 2 years? If you're self-employed and you are changing your job, well, you've just changed it. We don't have anything to compare. We don't have any sort of 2 years worth to average.
Mm-hmm. Gotcha. Thank you. So we've covered things like credit score, kind of what's the ins and outs of managing your credit score and possibly improving it, the down payment options, loan products. Don't forget the closing costs. And then we've covered income and how to make sure your income is appropriately designed, I guess, or set up for getting a loan. What if we left anything out, anything you would want to add to this list of things to help people kind of get ready?
I think that's all great. When it comes to the funds piece, just making sure where those funds are coming from. So is that in your savings account? Is that from your 401k or an IRA? Making sure that you're talking to Michael Reynolds to make sure that there's no penalty involved. Is there a way for you to borrow against something with no penalty? So it's not just having those funds and knowing where they're at, it's knowing what's going to take to liquidate those as well. But otherwise, I think we pretty much covered the information that it would take for someone to become a solid buyer.
And one quick side note, not to put you on the spot, but my understanding is that liquidating cryptocurrency can be problematic when using it for a down payment. Is that correct?
So make sure that the lender that you intend to use accepts cryptocurrency as funds for down payment, because currently a lot of lenders are not.
So, for example, let's say you work with a lender that does accept cryptocurrency. They could look at your, Coinbase account, for example, and say, okay, you've got this much in Bitcoin. We know you're going to liquidate it for the down payment, but we'll go ahead and accept it. Or is it more a matter of, let's say you've got Bitcoin, you liquidate it all, and then the next month you apply for the loan with the funds that have been liquidated the month before? Are those two different scenarios?
So when it comes to funds, details matter again. So where are those funds at? How long have they been there? So a lender's going to need the last 2 months of bank statements prior to closing. So if you do a pre-approval, we need the most recent month, expecting 30 days to close from the date your offer gets accepted on average. So then you'll get the next month. So if there's a large deposit, such as the liquidating of the cryptocurrency, they're going to need to see where that came from. Make sure you keep all documentation that shows that you liquidated it, as long as that lender accepts crypto or Bitcoin for the funds for down payment. They just need to see that large deposit. A lot of times it's just best to keep your funds where they're at. Don't do anything with them until you get your offer accepted and have that lender give you the appropriate steps for liquidating those funds.
Okay. Gotcha. So I thought that was an interesting side note in our current age of digital assets. So a lot of people are, I shouldn't say a lot of people, but there is a scenario where someone could use their, assets in their Coinbase account as their down payment and not realize there's a timing issue of, when do you liquidate? So it sounds like the best practice is, again, if I could take one takeaway from this whole conversation, it's 3 to 6 months before you think you're going to buy a house, start a relationship with the lender at that point and tell them everything. Tell them, hey, here's my income, here's my assets. I have crypto over here and bank accounts over here and investments here, and basically give them the whole picture, because it might take 3 to 6 months to get you at a point where you are eligible for the right kind of house that you want.
Yes, that's perfect. And if you are in the Indy area or anywhere in Indiana, I do work with real estate agents. I'm out of the FC Tucker Keystone office. I do know other real estate agencies in the area. So if you are looking to purchase a home and you don't have a relationship yet with a lender, please contact me, and I can also get you in touch with a real estate agent as well.
Well, that's a great segue. Let's tell people how they can contact you, because obviously, so you work just in Indiana. So if someone's listening from some other state, as much as they would love to work with you, they probably need to find someone local to them. But if they're in Indiana, it sounds like you welcome people reaching out to work with you or consulting on getting ready to buy a home. So what's the best way for people to contact you? We'll put a link to your information in the show notes, but if you want to give a shout out, how can people find you?
Sure. So, and I'm unlike other lenders. I work day, night, and weekends. So please feel free to call or text my cell phone. So yes, it's a 765-413-6521. You can also email me at brittany.green@tuckermortgage.com. And that's spelled BRITTANY.GREEN@tuckermortgage.com.
Wonderful. And I can attest that you often, we're working on, maybe referring a client to each other, and, it'll be like 6 o'clock at night or over the weekend, and you're, texting an update, and you pretty much work. I know you don't work all the time, but you're available on a very flexible schedule, which I think is really appreciated by a lot of people you're working with, because home buying is not always a 9 to 5 weekday kind of thing. Right. It's the schedule could be crazy sometimes when you're wrapping things up. So, well, it's been awesome. Really useful information. So I really appreciate you sharing all these insights with us. For those who are thinking of buying a home, really, really useful stuff to get ready. Well, so I'm sure you'll be back. But I just want to kind of give a shout out as well. I appreciate the care you take with all of your clients, and really just serving and helping people. That's what you're all about. It's not about the business for you. It's about helping people. So that's something you live every day. So appreciate that about you, Brittany.
Thank you.
All right. So with that, we'll wrap it up there. As always, appreciate you being a listener today. If you'd like to contact me, my website is elevationfinancial.com. You can always book a meeting with me online or send me a note through the website. And also, if you didn't catch Brittany's contact info, want to get in touch with her, send me a note. I'll make sure I put her in touch with you. So, all right. Thanks, everyone, for joining us today. Have a great day. See you next time.